Canadian Armed Forces are really good. And if I can borrow a phrase, the world needs more Canada.
Welcome to On the Edge, coming to you from Richmond, British Columbia. This is for educational purposes only and is not investment advice. We started things off with Barack Obama from 2016 saying that the world needs more Canada. And of course, just recently we've heard from Donald Trump, and he also has his eye on Canada. So what we take from this is that both from a political perspective and from a market perspective, there is a strong case and desire for more Canada. Now, what is the common driver here? Well, we believe it is that we've now entered into a period of structurally elevated geopolitical risk. And what does that entail? Basically, because of intense global economic competition amongst nations, national security risks and perceived risks are rising. And it's not hard to understand why. When we look just recently, and we've seen government in Syria collapse, government in Canada basically collapse, our current government's basically a lame duck government, and that all happened in response to Donald Trump's tariff threats and warnings that came about shortly after his election, and that destabilized things in Ottawa. And we had, of course, the famous resignation announcement from Justin Trudeau. He's still Prime Minister, but pretty much a lame duck Prime Minister at this point. So these national security concerns are essentially leading to a hoarding of industrial and financial commodities, because one never knows, if you're a global player and a leader, when you could be faced with a conflict, whether it's kinetic as we saw in Syria, or economic, basically as we seem to be having in Canada. But more on that in a minute. When it comes to industrial versus and financial commodity situations, we saw an example of this just last week. Now, on December 30th, in the Market Inc. report, The World Needs More Canada, Part 1, we warned that the Biden administration was at risk of slapping more sanctions on the Russian oil industry, and that would target the transportation of oil. And sure enough, on Friday, January 10th, that's what happened.
The sanctions are imposed today because they will have profound effect on the growth of the Russian economy and make it more difficult for Putin to conduct his wars. It is probable that gas prices could increase as much as 3-4 cents a gallon.
On that day, the Canadian Insider Index, 50 stocks preferred by insiders in Canada, it outperformed most indices around the world. That day it was good to have more Canada, even though the index fell on that day, it fell less, thanks to rallying oil and gas stocks. And that brings us to the oil and gas area, because it's one area that makes the Canadian market, we think, very attractive in this new environment. We looked on January 8th, in our January 8th morning report, we looked at 3 of the oil and gas leaders in the Canadian Insider Index. Today, let's just focus on Frontera Energy. It is a Latin American producer, and it produced 42,450 barrels of oil equivalent per day in Q4. Now, most of that was oil, not about 93% or 90%, over 90% was oil. Most of their production is from Colombia. Now, the company has also hired Goldman Sachs to assist it in a strategic review of its Colombia infrastructure business. That includes pipeline business, water treatment. It includes an import-export terminal, and I believe a palm oil plantation. The company also has a JV in Guyana looking for petroleum offshore. Now, it's sent a letter to the Guyana government, apparently about some concerns it has with respect to some statements by some officials, so keep an eye on the news feed for any developments there. One material development that has happened at Frontera recently, in December, they announced that they would be repurchasing, I believe, up to 3.5 million shares at $12 a share. That's a $42 million potential buyback. You can get the documents or read about it, of course, on CDR Plus. But this is the second time they've done this recently. They completed a repurchase via tender in October. That repurchase was worth about $40.5 million, also at $12 per share. Now, the one certain thing that we're confident of in this world of elevated geopolitical risk is that events will take uncertain turns. Now, we see an example of this in Europe. Back 2 years ago, the president of the European Commission, Ursula von der Leyen, had some thoughts about where Russia stood in terms of its industry.
Russia's industry is in tatters.
Well, fast forward to today, and that's not exactly how things turned out. In fact, we had the Secretary of NATO complaining that Russia was actually outproducing European nations in terms of industrial capacity. And that has him concerned and is encouraging Europe to spend more on defense to keep up with Russia. Now, one of the aspects of the Russia-Ukraine war that's not going so well for Russia is the situation with its central bank reserves. As we reported in the December Inc. Top 20 mining and crypto report, according to the EU, about over half of Russia's central bank reserves have been frozen. Now, our understanding is there are about just over $600 billion worth of Russian central bank reserves. And if over half of that is frozen, that would be just over 300 billion of reserves frozen. Now, the unintended consequence of this, again, is what is forming the base of this elevated geopolitically risky period that we're in. The freezing of these assets has had the consequence of putting basically a risk premium on US dollar reserve assets in the Western financial system, because a lot of sovereign actors would have looked at this Russian asset freeze and go, well, better Russia than us. It does still leave a lingering risk that, well, what if it's somebody else next time? So that prompted a flight to gold over the past couple of years, pushed the gold price up, and that confounded many Western business organizations. They didn't know what to make of it. Why is gold rallying when the Fed was tightening? It's something we've covered for a couple of years now, and we still don't see a quick resolution to that. Even if Donald Trump is successful and determined to put an end to the Russia-Ukraine war, it's going to be very difficult for him to untangle this asset freeze, in our opinion. It's going to take a lot of work, and we will have to see if he is able to accomplish, and even if he tries to do something like that. Until that is dealt with, we suspect that there's going to be this risk premium on reserve assets in the Western financial system, and those Western assets will continue to be diversified, and gold should be a beneficiary of that, and potentially cryptocurrency, Bitcoin, depending on how much traction that gets. Some smaller countries have looked at it, and with individuals, crypto has some appeal, but generally gold is seems to be the big winner from that development. Now that takes us to the gold space, and in Canada we have plenty of gold miners, and we looked at Rio 2 this week in the morning report. Rio 2 is building the Phoenix gold mine in Chile. The gold mine is expected to have a life of 16.2 years, and during the mine's life, it's expected to produce 1.3 million ounces, thereabouts. So it gives you an idea of the scale that they're working on. They are moving ahead. So check that report out in the morning report on January 13th. Interestingly, that Rio 2's chart looks a lot like many charts we see in the gold space. Another company that has a similar chart is Torex Gold, one that we've talked about quite a bit here. And it almost looks like investors are consolidating here, not sure if this gold rally is for real, and for the reasons that we've just described, we feel that it is. This period of elevated geopolitical risk is with us structurally, and that is going to support, in our view, the gold price for a long time. One of the big benefits of the Canadian market is having so many gold miners to choose from, and why we think that the world does need more Canada right now. And that doesn't mean, however, that there aren't risks. And one of the biggest risks facing the Canadian investors is government regulation of the resource industry and permitting risk. For example, let's take a look at Ontario, where we've had two new mines come on stream. That's great, but it's not quite the victory lap that we think it seems, because from a regulatory front, you look at the IAMGold Cote mine in Ontario, it took 15 years, let's say, from pre-discovery to operations. You got the Equinox mine in the Thunder Bay area. That is a long project, and just to, I think, being generous in terms of the timelines, it took 17 years from recent exploration, I would say, to production. And by the way, the Cote mine is in Timmins, and the Greenstone mine for Equinox is in around the Thunder Bay area. But the issue there for both mines is not relating to the company, but relating to the regulatory environment we have in Canada. And that brings me to Doug Ford. Doug Ford has been in the news lately, talking about tariffs and telling Donald Trump that Canada could retaliate if he's gonna put tariffs on us. And the problem with this approach is that it reflects a misunderstanding, in our view, of what's going on in the US, both from the Premier of Ontario, but also in Ottawa. They seem to believe that we're at a situation where the US is targeting Canada and wants to start a trade war. Now, if they were targeting specific industry, like, for example, the lumber industry, which we've had disputes with them on for a long time, then there's kind of a conflict related to that industry. But it is looking like the United States is doing an overhaul of its trading and fiscal and national security strategy. This is bigger than, or different, I should say, than a trade war. And in fact, the only way it will become a trade war is if we retaliate. So it really is getting questionable whether this talk of retaliation is really in Canada's interest. So here is an idea for Doug Ford, that instead of talking, how about getting back to work and making sure Ontario issues mine permits expeditiously and quickly. For example, Generation Mining wants to build a copper palladium mine at the primary end of the auto industry value chain, very dear to the heart, we know, of the Ontario government. But it was supposed to get its Ontario permits last year. Now, believe it or not, the Trudeau government has given this mine all the permits it needs from the federal government. But they are still waiting for the permits from the Ford government. So here's my challenge to Doug Ford. Doug Ford has a chance to show us that he's a politician that is more than all wind and no sail. How about Doug Ford work very hard to get those permits issued in the next few days before Donald Trump becomes president? That would set a signal that Ontario is serious about getting competitive and the government is taking the lead on that because there's no shortage of entrepreneurs that are working very hard in Ontario that want Ontario to succeed. But the government's got to do its part. The government has to get in shape. The government has to be efficient. And that is one area that Doug Ford can actually have an impact on. He can change the behavior of his government. Doug Ford cannot change the behavior of Donald Trump. He will not change Donald Trump's attitude towards tariffs. Justin Trudeau will not change it. The ministers in his government will not change it. The tariffs boat has left the harbor, and now it's up to Canada to determine how we're going to compete in that economic ocean. You know, that brings me back to something that Jean Chrétien said. Jean Chrétien, once I remember him saying, the best way to beat your opponent is to live longer than them. Interesting. Didn't say to retaliate, didn't say to get even. He said to live longer than them. And Jean Chrétien, of course, just turned, I believe, at 91 this month. So he is a great example of Canadian competitiveness. So getting competitive is the best way to deal with Trump's tariff world. Retaliation is just raising taxes on Canada, and hopefully it's just a bargaining position, but I've yet to see any insight from Canadian political leaders that they understand what's really going on. But look, let's start with Ontario. Let's see if Doug Ford can get some mining permits issued quickly and get that end of the value change in the auto industry that he can have an impact on. Let's get it moving. Now, the other aspect of the Canadian market that I think requires recognition is that it offers some risk reduction opportunities for global and American investors on a portfolio basis. In our World Needs More Canada Part 2, we looked at how the Canadian Insider Index did versus the S&P 500 since the start of the Russia-Ukraine war, which we would kind of set as a kind of a signpost or when this elevated period of geopolitical risk really started to get going and was really kind of baked in the cake at that point. And since that war started, the index, the Canadian Insider Index, has had a beta of 0.82 compared to the S&P 500, meaning that the Canadian Insider Index had relatively low volatility in relation to the S&P 500, and that gives global investors the opportunity to engineer lower portfolio risk by having some exposure to Canadian stocks preferred by insiders. So reducing risk is one key attractiveness of the Canadian market. But insiders have been no slouch either at identifying opportunity. The Canadian Insider Index in 2024 returned 21.8% on a price basis, and that was within the shouting distance of the S&P 500, which I believe returned about 23% on a price basis last year. And the Canadian Insider Index did not have the benefit, of course, the Mag 7 AI type exposure. So opportunity is still pretty good in Canada based on our signals. The Inc. indicator, which tracks insider sentiment, is still above 100, meaning there's more stocks in Canada, key insider buying than selling. Suggests that opportunity still presents itself in the months ahead. Well, let's just look at some of the things that Donald Trump could do that could bring the temperature down on the global stage in terms of risk. He could not only, I think, stop the engineer an end to the Russia-Ukraine war, but I think it would take a bit more than just that, because there's still many other conflicts going on. He would, I believe, have to engineer and achieve some type of security arrangement, grand bargain between Europe, Russia, and the United States. If he's able to achieve something like that, it would be a real turning point. And also if he's able to get the US deficit, the GDP ratio down, because that deficit, it's really spurring on US growth, but it's risky growth. And it's, I think, one of the factors driving this global economic competition. So if that were to become under control, if we were to get a grand bargain in Europe, that would really kind of, I think, be a turning point for things. And if that happens, dividend pairs would be in pretty good shape. We would see, because we could probably see bond yields coming down if some of these, the risk premium in US, we believe in US reserve assets comes down. And one stock that we looked at recently on January 9th in the morning report was Dexterra Group. Now they've had a benefit, the stock has had a benefit since the Trump election. It's had a nice rally. Part of that is because they've got facilities management business, and they recently acquired a US-based company that's in the facilities management business. So they've had some tailwinds from the Trump trade. The quarterly dividend pair, Dexterra Group, it has a prospective yield of about 4.5%. So it's in that group that could potentially do well if bond yields start to head lower and we come back to more of a peaceful global environment. So that's our video today. Thanks for stopping by and hearing about our take on the structurally elevated geopolitical risk environment that we're in. That is, we think, one key driver that's supporting industrial and financial commodities, which is front and center in the Canadian market. So take care, everyone, and we'll see you again next time.